Hey everyone, welcome back to Corporate Decoder, the place where we unravel the secrets hidden within the financial world, especially when it comes to real estate investment trusts or REITs. And let me tell you, today's filing is packed with so many numbers, it's like navigating a financial maze. Think of it as a treasure hunt for clues about a company's true health, and we're going to find that treasure or at least figure out if the map is leading us astray. Grab your popcorn because we are diving deep into the 2025 annual report of Four Corners Property Trust, Incorporated. Ticker FCPT, their bread and butter is owning and leasing out properties, mostly to big restaurant chains, and they also run a few restaurants themselves. It's a REIT, which means it owns income, generating real estate, and since it had a rather large investment of over $325 million in new properties in 2025, we need to see how that is playing out. Alright, let's jump right into the heart of it, the financials. For the year ended the 31st of December 2025, FCPT saw its total revenues reach a hefty $294 million. That is a solid jump from the $268 million they pulled in back in 2024. This growth is good, and it's driven by their real estate operations as expected. But let's dig into what this really means. Revenue from their rental properties alone hit an impressive $262 million in 2025. That's up significantly from $237 million in 2024. This makes sense because they acquired a bunch of new properties, over 100 new rental properties and ground leaseholds in 2025 alone. They are actively buying and leasing out properties, which is what a REIT does. And the numbers show they are doing it. It is like they're constantly adding new rooms to their big real estate hotel. Now, speaking of hotels, they also have a small restaurant business, the Caro Restaurant Operating Business, and that brought in about $31 million in revenue in 2025, which is pretty much flat compared to 2024. This part isn't their main focus, but it's worth noting it's not losing ground. When it comes to expenses, it's no surprise that they've seen an increase. General and administrative expenses went up by about $3.1 million in 2025 compared to 2024. Management says this is mainly due to higher compensation costs and increased professional fees. Think of it as the cost of managing a larger portfolio. More people to keep track of everything, and more lawyers and accountants to make sure all the contracts and regulations are in order. It is the price of growing bigger, and then Therese depreciation and amortization, which basically means accounting for the wear and tear on their buildings and equipment. This expense saw a nice jump of about $5.9 million in 2025 compared to 2024. That is directly linked to all those new properties they bought. They are also depreciating those older assets, and they even had to record an impairment of almost $1 million on one property in 2025. An impairment means the value of that property dropped, and they had to adjust their books to show that loss. It's a reminder that real estate values can go down as well as up. Now let's talk about debt, because owning a lot of real estate usually means borrowing a lot of money. Interest expense went up by about $2.6 million in 2025 compared to 2024. This is mainly because they took on more debt, an extra $75 million in term loans in early 2025. It's like taking out a bigger mortgage, and of course that means paying more interest. They are trying to manage this by using something called interest rate swaps. Imagine swapping a variable interest rate payment for a fixed one. It's a way to get some predictability in their borrowing costs. They've got a pretty complex web of these swaps, hedging over $500 million of their debt. So with all this going on, what's the bottom line? Net income came in at $112 million for 2025. That's a pretty healthy increase compared to $100 million in 2024. This shows that even with higher expenses and more debt, their core rental business is growing strong enough to boost their profits. But for REITs, we often look beyond just net income. We look at FFO, or funds from operations. It is a common way to measure how well a REIT is actually doing operationally, by backing out things like gains or losses from selling properties and depreciation. For 2025, their FFO was about $172 million, up from around $155 million in 2024. This is a good sign, as it shows their operations are generating more cash than Therese AFO, or adjusted funds from operations. This metric tries to give you an even clearer picture by adjusting for things like straight-lining rent, which is an accounting method, stock-based compensation, and other non-cash items. Their AFO for 2025 was about $183 million, up from $162 million in 2024. This is the number they use to see how much cash they have to pay dividends, which is super important for a REIT. And looking at the AFO per S hair, it went up from $1.73 in 2024 to $1.78 in 2025, a small but solid increase. It is interesting to see that stock-based compensation expense is also on the rise, going from around $7 million in 2024 to nearly $9 million in 2025. This is a non-cash expense, meaning it doesn't affect their cash flow directly, but it does dilute ownership for existing shareholders. It's basically the cost of rewarding their employees with company stock, and it's growing as the company likely grows its workforce and grants more awards. Now, let's talk about risks, because with any investment, it's crucial to understand what could go wrong. And for FCPT, a massive risk is their dependence on Darden restaurants. Darden is their biggest tenant, making up a huge chunk of their rental income. The report spells it out. If Darden's business takes a hit, FCPT. Business could also take a massive hit. This is a classic case of having too many eggs in one basket. They are actively trying to diversify, but Darden is still the elephant in the room. And it is not just Darden as a company, but also the brands. A big chunk of their restaurant properties are Olive Garden locations. So any dip in popularity or sales for Olive Garden directly impacts FCPT too. It's a double whammy of concentration risk. Then to raise inflation, the report mentions that inflation could really hurt them, especially because they have a significant amount of variable rate debt. While they have some hedges in place, sustained inflation can still increase their borrowing costs and potentially affect their tenants' ability to pay rent, if those tenants also have rising costs that outpace their revenue growth. It's a delicate balance, and inflation adds a lot of uncertainty. Looking at their debt, it is substantial. They have over $1 billion in term loans and senior unsecured notes. While they have an investment-grade credit rating, which is a positive sign, the sheer amount of debt means that any increase in interest rates could significantly impact their bottom line. It also means they have less flexibility to pursue new opportunities if they need to focus on servicing their existing debt. They are certainly leveraging up to grow, which is common in real estate, but it does amplify risk. So, what is my take on all of this? FCPT is clearly in a growth phase, aggressively acquiring properties, which is generally a good strategy for a REIT. Their FFO and AFO numbers are moving in the right direction, indicating their underlying operations are healthy and generating more cash. However, the heavy reliance on Darden is a significant overhang. Think of it like a popular restaurant. If that one restaurant suddenly gets a bad reputation, the owner of the building feels it too. They have managed to execute well on acquisitions and access capital, which shows good management execution in a competitive market. The rising interest expenses are a clear concern, and while their hedging strategies are in place, they are still exposed to market fluctuations. The company's direction is focused on expansion and diversification to de-risk from Darden, but it is a slow process. Their strategy is sound in principle, but execution and timing in the current economic climate are key. The biggest opportunity lies in successfully integrating new tenants and brands, while the biggest risk remains the health and loyalty of their primary tenant, Darden. That is our deep dive into Four Corners Property Trust's 2025 filing. What are your thoughts on their growth strategy and their reliance on Darden? Let me know in the comments below if you found value in this breakdown. Please hit that like button and subscribe to Corporate Decoder for more insights into the world of finance. And hey, if you want to connect with other finance enthusiasts and dive deeper into these topics, join our Discord community. The link is in the description. Thanks for watching, and we'll see you in the next one.